Today, we're going to go over how you can pay off your mortgage in under 10 years, not 30, and how you're going to save yourself six figures of interest, simultaneously set up for yourself a tax advantage retirement account, and all without sending extra money to the bank. Doesn't that sound nice? It's all about proper structure, setting up your money in the right, smartest way, and positive cash flow. Put all those things together, and it's not much, by the way, and suddenly you have a paid off mortgage in under 10 years. I'm going to get into it. We're going to get into it on the screen. Here we go. So over here, we've got a $700,000 house, right, with a 30-year mortgage at 6%, let's just say, and a $500,000 balance. That means a $3,000 a month payment. Now, if you think about that, that's not even including the insurance and the taxes, but let's just focus on the principal and interest payment, right? $3,000 times 12 months. In the first year, you're going to have spent $36,000. What do you think your balance is at the end of 12 months, right? You've spent $36,000, remember. Unfortunately, I'm sorry to tell you that it's $493,000, $859, I should say. And so what did you do? You basically peeled like not even $7,000. Basically, you peeled off $7,000 from that principal by spending $36,000. Now, that's the bank's interest, right? The difference is what the bank got to take for giving you that loan. All right, fine, but it sure feel nicer if I had more principal after spending $36,000. Sure be nice if my mortgage balance was lower, right? Now, of course, we could talk about this. We've got in this scenario, this person over here has a $50,000 savings account. And in my example as well, they have a surplus of $50,000, meaning that their income minus their expenses in their checking account leaves them with $50,000 at the end of the year. Now, these are rounded numbers for simplicity. You know, $50,000, it's a tenth of $500,000. I look at everyone's individual numbers, and we can make this happen for most people as long as they're cash flow positive. But these are simple illustrative numbers. Don't read too much into it. But nonetheless, for example, let's dig in. So $50,000 savings over here, and we talked about how they're making money at the end of the year in their checking, right? It doesn't take a rocket scientist to understand that you could send this $50,000 over here to your mortgage, right? You would be paying down your loan. Your loan balance would go from $500 to $450. But what else would I get? Would I get a lower payment? No, unfortunately, you would not get a lower payment because your payment is contractual. When you sign those mortgage documents, what your payment is going to be every month is pretty much set in stone. So what do you gain? Pretty much my 30-year mortgage becomes a 23-year mortgage. What I gain is I don't have to pay 7 years on the back end, right? I'm going to be finished in 23 years. Well, I talk to people all the time about this. Often they had that $50,000 sitting in their savings account and they have not sent that money to their bank. And when I ask them why, it's frankly because it's very hard for people to get excited about saying goodbye to $50,000 today just to see a benefit 23 years from now in the future. Are you kidding? In today's instant gratification world? No, thank you. I'll keep that $50,000 in my bank account, right? And for that reason, people don't do it. They don't get the lower payment. The benefit they do get is 23 years in the future in this example. And then lastly is the rainy day issue. What if I lose my job? What if there's a horrible car accident and I got a big deductible? I need that money. I need to have access to that money. If it's in my bank's bank account, that means it's not in my account. And if I want to get a hold of that money, I either have to sell this house, which I probably don't want to do, or I have to do a refi. And frankly, if I've just lost my job, the chances of me getting a refi are really, really small. So for that reason, people stick with this divide. They have a wall up between their banking world and their mortgage world, and these two don't mix. Now, if only they could, though, there would be a better way of banking, mortgaging, if that's a thing. So what I'm here to talk about is that there is a better way, of course. That's my whole thing. And that better way is an MFL loan. So let's talk about what the MFL loan system is and how it will benefit you. Now, there's a lot of benefits, but today we're just going to focus on the banking side because that's what we're talking about here on the mortgage thing here. What it's going to do is it's going to allow us to link these three things together, meaning our checking account, our savings account, and our mortgage are all going to become one account. And one, therefore, is going to offset the other. So let's think about that for a second. So now we've got this savings account over here. And now we got rid of that wall. This savings account is benefiting us over here on our mortgage. That means that our $500,000 balance is really going to turn into a $450,000 balance. But I'm also happy to report that we right away get the benefit of a lower payment, right? Remember how people were usually wanting that. Yeah. So we're going to get the benefit right away. That $50,000 is going to lead to us having a smaller payment next month. Now, remember, I also talked about the rainy day issue. But I need the money. What happens if there's an accident all of a sudden? Just like a savings account, I can take the money out. I can put the money in when I need to. So if it's in my MFL account over here together with my mortgage, it's no issue. If I need to move it back over here to my savings account, I can. It's as simple as setting up a transfer on my bank app. It's that simple. So if I need the money, I have it. But while I'm not having a rainy day issue, I have the benefit of getting a lower payment. Now, remember, I also talked about the positive cash flow that this person has. In this example, just to make it easy, $50,000 at the end of a year left over in their checking account. Where does that come in? Here's where that comes in. That money at the end of the year, usually, realistically, it comes in every month, but we chalked it up to the year to make it simple. At the end of the year, that $50,000 is also peeling off my mortgage balance. So my mortgage balance went from $500 to $450, now down to $400. That lowered my payment. And as I continue to earn money with my job, etc., and I have this surplus in my account, that further brings down my payment every time that I move the surplus of my checking account into my MFL account, right? Because it's all one account. So as I'm earning, it's offsetting what my mortgage balance is. That brings the payment lower, 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 until eventually I have no payment at all. Now, this is a high level of the structure. Now I'm going to go into the calculator to show you the numbers behind this math, to show you that this is all real. It's not magic. It's just math. Here we go. Okay, so let's dive into the calculator. Here's that $700,000 house with a $500,000 balance for the next 30 years, right? That payment comes out to just under $3,000 a month, right? Like we talked about. Now, this person here, like we said, they've got about $4,100 left over at the end of the month and their expenses. The $7,500 includes their taxes, their insurance, as well as their groceries, their car payments, their insurance, and all of the things, right? They're left with about $4,100.66. They're left with that money every month. Times 12, they're left with $50,000. Again, illustrative purposes, making big round numbers just to make the math easy. Let's see what the math comes out to. So here we go. We're able to pay off this mortgage in 9.33 years. As it says in the fine print underneath here, 20 years, basically 20 years and 8 months faster, right? Saving well into the six figures of interest, $360,000 of interest. That was money you were going to spend, understand. It's money you were already on schedule to spend that you are not spending now because we got smarter about how we're structuring our banking and our income and our cash flow, right? That's what it's all about. And let's go 4 years into the system. Here, this, again, all the numbers, everything you've seen before, everything we've talked about. Here, a person would have a loan balance of $328,000, doing it the MFL way, being smarter about how they're banking and how they're structuring their finances, right? But here, doing it the traditional way at 6% interest, after 4 years of making a $3,000 a month payment, right? That's 36, that's 72, that's $144,000 in principal and interest payments. And on your $500,000 balance, you've barely peeled off just over $25,000 off of that balance. Would you rather be here in 4 months, or would you rather be here in 4 months? I'm not even talking about having it paid off. I'm just talking about looking so much better on your balance sheet because you own so much more of your home. Of course, we can scroll all the way down. Let's look at here. Let's look at payment 108. At a payment 108, your balance doing the MFL system, you're going to have a balance of $28,000. But if you did it the traditional way, you're going to be at $429,000. You're still not under $400,000 in loan balance after 108 payments. That's just painful, right? So if this is making sense to you, then this is what I ask folks to do once it's starting to click. What I want you to do is I want you to email me, Aaron at KHA Group. Group is just no vowels, GRP, okay? Aaron at KHA Group. I'm going to put it on the screen. I'm going to put it in the description, okay? And email me this information. I don't need a whole lot of data to figure out if your numbers work for this. I need to know what state you're in. I need to know what's your home's current value, what's your home balance, your mortgage balance, excuse me. I need to know what's your interest rate. What is your current principal and interest payment with the taxes and insurance, right? So what is being mortgaged, right? Typically, what is that total mortgage payment with taxes and insurance? What is your gross income? And I need to know what's your take-home pay. Don't tell me before taxes. I want to know after taxes and withholdings, right? And then tell me what your monthly expenses are. And then, by the way, for bonus, this will help you kickstart the whole program. Let me know if you have any liquid savings like money market or savings accounts, because that is going to help you jumpstart the system, because we're going to get the MFL loan system to make all these things, your checking, your savings, and your mortgage, to come together where one starts to offset the other. And that's what gets you that lower and lower and lower payment every month until eventually you have no payment at all. I hope you've enjoyed this video. There's a lot more of this on my channel. We talk about all things having to do with saving money, making more money, and just being smarter about how we're structuring our financial lives, our banking, our investments, our insurance, etc., saving on taxes, you name it. Thank you so much. Hope to see you on the next one.